Let's take you live to Ottawa. Here is the Bank of Canada Governor Tiff Macklem commenting on the decision to keep rates steady.
Whether our policy rate is restrictive enough to restore price stability, to how long it needs to stay at the current level.
Laissez-moi vous donner un
Let me
peu de
give you
contexte et
some
vous parler des
economic
implications
context for
politiques
these
monétaires.
considerations and talk about the implications for monetary policy.
Uh-oh. Little problem. Missing a page. Merci.
Thank you.
OK. Je vais reculer un peu. Laissez-moi vous donner un peu de
Back.
contexte et vous
Let me
parler
give you
des
some economic
implications pour
context
les
for these
politiques
considerations
monétaires.
and talk about the
La
implications for monetary
croissance
policy.
mondiale a
Global
ralenti,
growth
mais
has
pas
slowed,
autant qu'on
but
le
not
pensait.
quite as much as we
C'est en
thought it
grande
would,
partie à
largely
cause de la
because
résilience
of the
surprenante de
surprising
l'économie
resilience of the
américaine.
US economy.
L'inflation recule dans
Inflation
la
is
plupart des
easing in
grandes
most major
économies,
economies,
mais elle est
but
encore
it remains
trop
too
élevée.
high
Elle ne va
and
probablement pas
is
retourner
not
aux
expected
cibles
to reach
des
central
banques
banks'
centrales
targets
avant
until
2025.
2025.
In Canada, economic growth stalled in the middle of 2023. For many Canadians, the combination of higher prices and higher interest rates has been difficult. But past interest rate increases have helped the economy rebalance, and this is relieving price pressures. Lower energy prices and improvements in global supply chains have also helped to bring inflation down. Growth is expected to remain flat in the near term. With weak demand in the economy, upward pressure on prices should continue to moderate, and inflation is expected to ease further. The share of CPI components that are rising faster than 3% has declined substantially and should continue to normalize. But tightness in some parts of the economy is continuing to hold inflation up. The most prominent of these is housing. Inflation in shelter services remains high, close to 7%, because of rising mortgage interest costs, higher rents, and other housing costs. And while food prices are not increasing as fast as they were, food price inflation is still about 5%. Finally, inflation in services excluding shelter has improved, but there are signs that price pressures remain. All this push and pull on inflation means that further declines in inflation are likely to be gradual and uneven. That suggests the path back to 2% inflation will be slow and risks remain. Overall, our outlook for growth and inflation is largely unchanged from the October report. Economic growth is expected to be modest in 2024, weak in the first half before picking up around the middle of the year and rising to about 2.5% next year. With downward and upward forces largely offsetting in the near term, CPI inflation is expected to remain close to 3% over the first half of this year. It is then expected to ease to about 2.5% by the end of the year and return to the target in 2025. In 2 weeks, we will release our summary of deliberations, which provides more detail about our monetary policy discussions. But let me give you a sense of that discussion. As always, Governing Council was focused on the decision at hand, the current policy rate. And there was a clear consensus to maintain our policy rate at 5%. We did, of course, discuss where we see the economy and inflation going and what that could mean for monetary policy going forward. What came through in the deliberations is that Governing Council's discussions about future policy is shifting from whether monetary policy is restrictive enough to how long to maintain the current restrictive stance. That doesn't mean we've ruled out further policy rate increases. If new developments push inflation higher, we may still need to raise rates. But what it does mean is that if the economy evolves broadly in line with the projection we published today, I expect future discussions will be about how long we maintain the policy rate at 5%. Governing Council is concerned about the persistence of underlying inflation. We want to see inflationary pressures continue to ease and clear downward momentum in underlying inflation. Si la situation change et que l'inflation repart à la hausse, on pourrait devoir
things move, then we may have
si
to
l'économie
have
évolue
the rates go
généralement
up.
comme
But
dans la
if the
projection
economy
d'aujourd'hui,
evolves
la
broadly in line
question
with the
va être
projection we
combien
published
de
today,
temps
I
le
expect
taux directeur
future discussions will
doit-il
be about
rester
how
à
long we
5%?
maintain the policy rate
Le
at
conseil de
5%.
direction est
Governing Council
préoccupé
is
par la
concerned
persistance de
about
la
the
forte
persistence
inflation
of underlying
sous-jacente.
inflation.
On va voir les pressions
We want
inflationnistes
to see inflationary
continuer de
pressures continue to
s'alléger
ease
et l'inflation
and
sous-jacente
clear downward
baisser de
momentum in
façon
underlying
durable.
inflation.
We also discussed the risks to the economy and inflation. We are trying to balance the risks of over and under tightening. We don't want to cool the economy more than necessary, but we don't want Canadians to have to continue to live with elevated inflation either. We remain focused on a number of indicators of underlying inflationary pressures. We need to see further and sustained easing in core inflation. With the economy now looking to be in modest excess supply, demand pressures have abated. Corporate pricing behavior has continued to normalize. At the same time, measures of near-term inflation expectations and wage growth suggest that underlying inflationary pressures remain. Let me conclude. We've come a long way from the peak of inflation in 2022. Monetary policy is working, and we need to continue to let it work. We remain resolute in our commitment to return inflation to the 2% target. And with that summary, Senior Deputy Governor and I would be very pleased to take your questions.
Okay, thank you, Governor. Let me just quickly go over the ground rules. We have a pretty full house here in Ottawa and some reporters on the line as well. So I'm going to start here in the room. I'll ask everyone to please limit yourself to one question to maximize our chances of getting to every media outlet. If I forget to do so, please state your name and affiliation. Avant de poser une question, veuillez vous identifier.
Ask my question, please identify yourself if I haven't done so. And as usual, you may ask your question in the official language of your choice.
Ottawa, I'm going to call on Steve Shear from Reuters, please.
Morning, Governor.
Morning, Steve.
You say there was a clear consensus to hold rates today. I wanted to ask you if anyone advocated for a cut, and is there any sort of broad timeline for when we might see a first interest rate cut?
With respect to the decision about what to do this morning, the focus across the council was very much on holding. I think there's a clear sense that yes, inflation is coming down, but we remain concerned about the persistence of underlying inflation. Monetary policy is working, but we need to let it keep working. And in that regard, there was a clear consensus to hold at the current policy rate. Going forward, as I outlined in my opening remarks, today we published our forecast. And what do we get out of the forecast? The forecast is really focused on where's inflation going and what do we need from monetary policy to get inflation back to target. And that forecast has increased our confidence that we have raised the policy rate enough to get inflation back to the 2% target. When you look at the indicator, but uneven. And as I said, we're concerned about the persistence in underlying inflation. And what that means is that it's premature to discuss reducing our policy rate. The discussion, our deliberations are shifting from whether we've done enough to how long we hold. But there was a clear consensus. It's premature to be discussing cutting our policy rate. We need to see more progress before we have that discussion.
Thank you. I'm going to go to Randy from Bloomberg now, please.
Good morning, both. Can you give us an update on the expected timeline for quantitative tightening, and are you expecting to have to make any changes to that?
As I said earlier, we maintain our policy of quantitative tightening. Our primary instrument for monetary policy is very much the policy, our overnight interest rate, the policy interest rate. With respect to quantitative tightening, we'll take it one decision at a time, but what would be the factors that would lead us to end quantitative tightening? Obviously, our balance sheet is gradually declining. At a certain point, it'll reach a more normal level, and it'll be time to start purchasing again to keep our balance sheet at the size we need. We put out some estimates about where we think that might be. Those are estimates. We're still some ways from there. As we get closer, we will certainly be continuing to refine that view and engaging with market participants. And I can assure you, as we've done every time we've changed policy with respect to our balance sheet, we will get out ahead of that and indicate, how we would likely do that. But we're certainly not there yet.
Thank you. I'm going to go to Raul from Epoch Times, please.
Thank you for taking my question. Does the Bank of Canada feel that it has engineered a soft landing and avoiding recession, and especially given the strong growth projected for 2025, which was previously projected? We had recession calls kept getting pushed further and further into the future, and so with the rebound projected in 2025, I wonder if that's not too premature. If you could speak to that, like given that rates would still be quite restrictive in 2025. So just wondering how you can have the economy grow, 2.4%, even with still relatively high rates.
Well, with respect to our projection, it actually hasn't changed that much since October. Right now, growth has stalled. It stalled around the middle of last year. We expect growth to continue to be close to zero. Well, we don't have the Q4 yet of last year, Q4 of last year, Q1 of this year. And then we expect it to gradually pick up over the course of the year. That is very weak growth. And when you're projecting something close to zero, could be some small positives, it could be some small negatives. As you indicated, we're not forecasting a deep recession. We don't think we need a deep recession to get inflation back to target, but we do need this period of weak growth. And what that has done is it has allowed supply to catch up. So we are now we think we're now in modest excess supply. So those demand pressures on inflation have abated. And that's certainly one of the key indicators we're looking at as we assess monetary policy going forward. With respect to the projection, if you look at the monetary policy report, it goes through the various components of demand that explain why the economy picks up. As you move later into 2024, we expect global growth to start picking up. Most importantly for Canada, U.S. growth picks up. That increases demand for our exports. Consumption starts to recover. The combination of that and investment and stronger exports starts to boost investment. And at the same time, if you look at our projection, because there's excess supply, inflationary pressures are diminishing. So you get, inflation gradually moving back towards the target through the second half of the year while growth is slowly picking up.
All right, we are listening to Bank of Canada Governor Tiff Macklem on why the Bank of Canada decided to keep the interest rate steady today at 5%. He said that there was generally a consensus about holding the rate, not increasing it. And perhaps more importantly, he said that at this point, it is premature to discuss cutting the rate. We're going to have more on this coming up.